Good morning. It's Thursday, the 29th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take: why a primary market problem is also a market problem. When a two-wheeler dealership with 2 outlets and 8 employees does an initial public offer or IPO, which gets about 4,800 crores worth of subscriptions when it only wants 12 crore rupees, something is going wrong somewhere. The primary market is a part of the stock market. It's always been the case that the secondary market does well, hits new highs, investors pour in, and the primary market starts gathering steam as well, and of course, small investor money. Usually, this story does not end well, or actually badly, at least for the not-so-sound companies. While the funds flowing into the primary market are lower, the exuberance there is a direct symptom of what is wrong with the stock markets as a whole, and therefore we cannot ignore the signs just because the amounts are relatively lower. Further, the most exuberance is clearly in the less regulated SME or small and medium enterprise initial public offer or IPO space, which is run by the stock exchanges like NSE and BSE and not the Securities and Exchange Board of India, the market regulator. But that does not change the fact that you could take the temperature for fever from any part of the body and it's still the same body and thus the same stock market. It's equally important to revisit everything that's happening in the secondary markets or the whole markets with a fresh lens. To its credit, the Sebi has made some attempts earlier, for instance, asking mutual funds to do stress tests with their mid-cap and small-cap funds, asking them to model what would happen if investors suddenly redeemed their units. Of course, while there is admitted froth in the smaller cap stocks, all of them have subsequently gone up even further to new record highs, like the rest of the market, which also hit a record high yesterday. The Sebi is now cautioning investors against price manipulation by putting out notice yesterday saying it has noted that post-listing, some of these smaller companies and or their promoters have been resorting to certain means that project an unrealistic picture of their operations. Such companies or promoters, it says, have been seen to be making public announcements that create a positive picture of their operations, usually followed up with various corporate actions like bonus issues, stock splits, preferential allotments, and so on. And the regulator says that such corporate actions create a positive sentiment amongst investors, leading them to purchase these securities. And at that time, this gives those promoters an easy opportunity to offload their holdings at elevated prices. Urging investors to be careful and watchful of these patterns and exercising caution while investing in these stocks, Sebi has said once again that we should not rely on unverified social media posts and not invest based on tips and rumors. All of this, of course, is good advice. I really hope and pray that people listen to it. Now, developed as an alternative source of raising funds for emerging businesses since 2012, the SME platform of stock exchanges has seen funds about 14,000 crores being pulled in the last decade, of which about 6,000 crores was raised last year, according to the Economic Times, adding that some SME stocks had even doubled on listing day itself till NSE imposed a cap of about 90%. We, of course, need SMEs to be able to access capital, but what we are seeing now is clearly an aberration. And it's an aberration that can shake up the entire market if ignored for too long, which goes back to the original point that a problem in the primary market, even if it's in that small segment of SME IPOs, is a reflection of something wrong at a much larger level. Meanwhile, a small corrigendum from yesterday, when I said that Nike listed in November 2021 around 2001 and is currently quoted around 226 and a little lower now, what I missed was the 5:1 bonus, which would mean that you have 6 shares instead of 1. But you're still at 1,300 rupees worth of shares, close to its issue price of 1,125. That's 6 shares into the current price. Of course, I also must mention that Nike's bonus move came in for a fair bit of criticism because it made it more expensive for shareholders to sell. For example, the cost of acquisition of 5 shares that you got as a bonus is 0, while the 1 share is what it is or was, and capital gains tax gets calculated accordingly. There are some other smaller nuances to this, but ICICI Direct, amongst others, has a good report on this bonus issue, which created, like I said, quite a stir in case you want to check it out. So I must thank those readers of our newsletter who pointed it out to be the mistake and, of course, a reminder to check what else was wrong at that time. On the same subject, some other IPOs from that time, which are quoting below water right now, are Delivery, Freshworks, and Car Trade. And that brings me to the top stories and themes for the day. Markets see the longest winning run in 4 years. Caution on Wall Street, though, even as it waits Nvidia results. Will captive units of multinationals absorb excess manpower that's flowing into IT services? Air cargo numbers rise in double digits for the 8th month. And Lego sales jump 13% in the first half of the year. You may have contributed to it.
This is the Core Report with Govindraj Ethiraj.
Markets continue their winning streak. The NSE Nifty 50 is now on its longest winning run in 4 years or since October 2020, gaining about 4% in 10 sessions. Analysts told Reuters that this was thanks to sustained local and retail institutional flows as well as money from portfolio management services and alternative investment funds that has obviously all bolstered the liquidity. The Nifty 50 hit a record high of 25,129 during intraday trade and closed at 25,052. That's up 34 points. And the Sensex was up 74 points to close at 81,785. As we said yesterday, the markets are not really shooting, but gaining steadily. And that's despite the absence of any major triggers here, except there, which is a potential rate cut in the United States, which has helped, among others, IT stocks, which are seeing a renewed boost of energy. Speaking of energy, Brent crude prices have slipped again. Now it's below $80 to quoting around $78.88 or just below $79. Some caution on Wall Street. The speedy return of market confidence following a dramatic sell-off in risky assets should be seen as a cause of concern, according to the head of asset allocation research at Goldman Sachs, who spoke to CNBC on Wednesday. Of course, you might be wondering, if your memory is short, like most of us are, when did this happen? Well, actually, it happened in first week of August. So Goldman's Christian Mueller-Klisman said investors could think about the early August stock slump as something akin to a warning shot. And for those, like I said, who need a reminder, in early August, the big worry was the unwinding of carry trades linked to Japanese yen, which pulled down stocks from record highs. So people were borrowing in Japanese yen and buying elsewhere. At that time, the S&P 500 lost 3%. That's on August 5th, the biggest one-day loss since 2022. However, since then, thanks to the belief that interest rate cuts were imminent apart from stronger economic data, the S&P 500 has jumped 8% since 5th of August, that is, and the Dow Jones Industrial Average has climbed 6%. Elsewhere, all eyes are now on Nvidia's earnings expected early this morning or after close of trade on Wednesday on Wall Street. Bloomberg said that stocks were hovering near all-time highs, with traders awaiting that Nvidia result for clues on whether the artificial intelligence euphoria that's powered the bull market has more room to run. And given its massive influence on broader indices, Goldman Sachs trading desk once called Nvidia the most important stock on planet Earth. Reliance's AGM is today. The initial public offer timelines for Reliance retail and telecom digital businesses is what markets are expecting from the company's annual general meeting today at 2 p.m. A report in the Economic Times says that last year, the AGM was noteworthy for the fact that the company unveiled a meticulous 5-year succession plan for the 3 children of Chairman Mukesh Ambani. This time, investors will watch out for timelines, targets, new partnerships, and other announcements regarding Reliance's diversified businesses that sprawl across oil and petrochemicals, telecom, retail, finance, and new energy, said the Economic Times. The great manpower movement. So the big question facing the IT services industry and the economy has been what happens if IT services slows down, as it has been in the last year, particularly in terms of new job creation. Now, we've been discussing for some time now and asking if global capability centers or GCCs or the captive arms of multinationals world over, in India that is, will pick up the slack. Now, there are a few different answers. First, they are picking up slack for sure by hiring steadily at higher rates, though on a smaller base, and also paying more because they're looking for more domain expertise, for instance, in retail or banking or even health tech, as we will find out shortly. A new report just out from Teamlease Digital says that from about 1,600 GCCs in India employing about 1.6 million professionals, India could go to 2,400 GCCs in 6 years, employing 4.5 million professionals. Many of these GCCs will be set up in Tier 2 cities like Kolkata, Ahmedabad, and Baroda, driving geographical diversification and employment in these locations. And of course, like I said, there are the highly specialist areas or recruitments that they're going to be doing. Neeti Sharma, CEO of Teamlease Digital, tells me that they are seeing almost 2 new GCCs being set up every day at the current run rate. So I began by asking her what prompted this report at this time and the most major findings that she drew from it.
So we basically come out with a skills and salary primer every year. And this time we wanted to specifically focus on how GCCs are stacking up, given the fact that today GCCs have become a very important sector for hiring tech talent across the country. IT services, as we all know, has not been able to hire the volumes that they used to hire in the past. However, GCCs are in a way offsetting that deficit to some extent. Also, the fact that GCCs are looking at talent and skill set combination slightly differently than what an IT services company would look at. So, our idea of getting this report out was twofold. One, to let people know where the jobs are growing, what are the skill sets that companies would look at, which cities are hiring, and which cities and which roles and which industries pay higher salaries compared to the others. So that was the essence of the report. We do this periodically, and this time around, we actually did a survey, of about 300 or 400 plus employers and, those many employees. Across 15,000 job roles, we've kind of identified sectors, about 10 sectors. So it's spread across those many JDs, job roles, it's spread across multiple skill sets and 10 sectors across, of course, the three industry segments that we're talking about, the IT services product, GCCs, and the non-tech sector. And the intent was purely to A, analyze where the jobs growth are going to be, and B, what are the skill sets for the near future.
Right. And what, in your mind, would be the one or two more, let's say, dramatic findings in this, in terms of the kind of people that GCs are hiring, the transition that's happening, or the movement that's happening, let's say, from IT services to GCC or otherwise?
Yeah, so absolutely. Where do you get talent? Not everyone's A, hiring freshers. B, not every talent pool is willing to move to GCCs. So the shift is happening from IT services on two count. One is the lateral, which is given. Especially lateral workforce who has specifically worked on a certain domain. GCCs are very happily hiring them. Give you an example: a BFSI GCC will actually open doors for tech talent that has probably worked in that domain under the IT services sector for a fairly long time, which means they bring domain expertise as well as tech expertise. And which is the reason why GCC's salary levels are a notch higher than the IT services salaries today, right from the entry level workforce to even leadership, purely because the composition of skills that GCCs look for is a tech plus domain and a tech plus something else, as against IT services, which initially looks at pure tech and then it kind of starts specializing. So one is that we've seen a lot of GCCs hiring from IT services. The other aspect of GCCs is we know today that we have about 1,600 odd GCCs in the country. About 45-46% of these GCCs are actually in Bangalore. About 28-30-25% probably are in Hyderabad. And the rest are spread across cities such as Mumbai, Pune, Gurgaon. And each of these cities, in a way, are creating specializations of their own. So Pune is specializing in product and auto engineering, the automotive GCCs. Hyderabad is, in a way, has a large talent pool and set up for healthcare and pharma tech GCCs. Bangalore, in a way, is a combination. So tech GCCs, retail GCCs, and couple of others. So this is something that we see. GCCs are expected to actually employ over 4.5 million youth by 2030, which is really 115% jump year on year from right now. But obviously, we see that's growth in our sector. So which is where talent is going to shift, which is where freshers are going to get hired as well, along with, of course, other sectors such as the non-tech and IT services.
Right. I'll come back to the IT versus GCC, but the growth reflects the fact that obviously many multinationals sitting in various parts of the world, North America, Europe, are wanting to set up these captive centers in India, and obviously have been doing so and have set up 1,600 at least so far. What is driving the acceleration right now? Companies have been setting up for a while now.
Yeah. So I think right now what India brings to the table, and I think all of us started, even the IT services industry started with purely as a cost arbitrage for the other countries, the other geographies, right? GCCs in India started, it's not like it started yesterday, it's been around for a while. The growth is increasing right now for three factors. One is, of course, cost, though it's not going to be a 1:4 kind of a cost arbitrage. It probably will be a 1:2 or a 1:2.5 arbitrage. Operating leverage, given the fact that the value we bring in terms of skill set right now and the cost obviously plays a big role. And the third piece is the talent arbitrage. I think the kind of people we are, the candidates that we are generating in our country No other country is able to give that kind of talent. Just as an example, there are auto engineering R&D centers in India, of large multinational automotive companies. Large part of them are between Pune and Bangalore. R&D in India was not a area that we had ever looked at. But given the fact that these companies are looking at setting up large research and development base in India, purely talks about the talent that we bring to the table. So today it's a combination of cost, operating leverage, and the value that the talent brings across to the table, which is where now we're looking at this, spiking up in the last couple of years a lot more than what has happened in the past. If you look at there are a lot of deep think centers coming up, innovation hubs coming up, GCCs in cloud cybersecurity. I think there's a whole range and a very exciting segment that GCCs are looking at to scale. Data centers, ERD, automotive, BFSI, retail, across sectors is what we look at growth. And in my view, it is the trinity of a cost, operating leverage, and talent arbitrage.
The more macro question. So, what would be, let's say, the median intake of professionals into the IT industry every year? What was it, let's say, a year ago, and which was largely getting absorbed by IT services companies? And how can that change? And will there be net addition or will it be flat?
So IT services, obviously, from last year to this year is going to have a growth very clearly. I mean, even though the growth may be a single digit growth right now, and then that's what we hear from all our partners in the industry. GCCs, however, the growth is actually in double digits. It's more than about 26 or 27% growth that we are looking at across
In people.
Yeah,
Right?
in people. Absolutely, yes. In terms of headcount. For two reasons, right? One is the existing GCCs are growing because they bring in more and more processes into India. And two is obviously there are newer GCCs being set up practically every day. Third aspect, Govind, is that a lot of state governments now are rolling out schemes and incentives to attract GCCs into even tier 2 cities, right? Which is a new angle. This had not happened in the past, but multiple states are actually giving incentives, creating tax holidays, and ensuring that GCCs come to those states into tier 2 cities so that there is also talent from tier 2 cities that can be hired into these roles. So, yeah, I think that's where the growth is also spiking in for GCCs right now.
So you're saying that there's a net positive at the end of all of this in terms of hirings that will happen in the IT sector?
Definitely. I think, yes. I mean, when I'm comparing it to last year, right, I'm not comparing it to the last 3 years because the last 12 to 18 months were very difficult in the IT hiring sector. There is change, there is upward movement, that's going to be net positive. And while we are all talking about, AI or Gen AI taking away jobs, clearly in India, they're not taking away jobs, probably getting used for productivity enhancement, and efficiency. But in the long run, it will definitely create more jobs, which will enable people to work better. While, of course, GCCs and even non-tech sectors higher. I mean, today, all of our organizations are tech companies. We are not non-tech anymore, right? I mean, we're using technology as we speak. So we all have our own technology teams creating products that we can use internally. So large part of hiring is also happening. In fact, in the non-tech sector, I think from 7.5 lakh headcount now, I think for the next 2 years time frame, we're looking at about 11.5 lakh headcount growth, which is also a good growth. So GCC is hiring, non-tech hiring, and IT services will hire better than last year, but obviously it's still going to be single digit for now. Obviously, because IT services is not hiring, so opportunities there are lesser, right? A lot of people have been let go. Bench strength has gone to almost zero in most IT services companies. The options are with GCCs. And I think as people view GCCs as a area where they can grow in their career, more and more people will actually start transitioning to GCCs. Whenever IT services goes back to their own original hiring, I'm sure they will also get the right set of talent. So I think at some point it will balance. But it's not like one is eating the pie from the other. That's not really where we are at the moment.
Got it. Neeti, thank you so much for joining me.
Pleasure, Govind. Lovely talking to you once again.
Air cargo numbers rise in double digits for 8 months. The International Air Transport Association, or IATA, has now released data for July 2024, which shows that global air cargo markets continue to grow up close to 14% compared to July 2023 and 14.3% for international operations. Now, this significantly is the 8th consecutive month of double-digit year-on-year growth, with overall levels reaching heights not seen since the record peaks of 2021, according to IATA. Capacity, measured in available cargo ton kilometers or ACTKs, increased by about 8% compared to July 23, 10% for international operations. Interestingly, this was linked to the growth in international belly capacity, which means commercial airlines carrying cargo, which rose about 13% on the strength of passenger markets and balancing the 7% growth of international freighter capacity, IATA said. IATA also said that the increase in belly capacity is the lowest in 40 months, whereas the growth in freighter capacity is the highest since an exceptional jump was recorded in Jan 2024. IATA's Director General said that air cargo demand has hit record highs with strong growth across regions, and the air cargo business continues to benefit from growth in global trade, booming e-commerce, and capacity constraints on maritime shopping. He also said that with the peak season still to come, it's looking like a strong year for air cargo. Lego builds brick by brick. So I don't have numbers for sale of Lego products here in India, but anecdotally, seeing the fact that they're displayed in more and more stores, of course, including chains like Hamleys, I can say that it is picking up in India. And of course, it's also available online. Anyway, globally, Lego has said that revenue during the first 6 months of the year jumped 13%, reaching about $4.6 billion. Niels Christensen, CEO of the privately held Danish toy company, told CNBC that the company is seeing strength across its portfolio, especially with Lego Icons and Lego Creator, and through its partnership with Epic Games Fortnite, according to CNBC. Apparently, last year, Lego saw consumers trading down or opting for lower price sets while still buying the same volume as the year before. This year, the CEO said volume is up. To the extent that they traded down last year, they're not trading further down, he said, and that has stabilized. And what we see now is almost all of the growth is actually growth in volume. So the Lego story is, of course, about innovation and extension, because many of their assembly projects are aimed at older and even older people, including 18 plus, involving fairly complex assemblies of several thousand pieces, and also themes like popular sports cars to Star Wars to NASA rockets. Lego now says the company has nearly doubled the amount of renewable and recyclable materials it uses in its bricks compared to full year 2023, and hopes to source over the next few years half its raw materials from sustainable sources. Meanwhile, CNBC also said that publicly traded rival Mattel saw net sales fall 1% in that first 6 months of 2024. That's calendar year, remember. And Hasbro has reported that its net revenue fell 21% between Jan and June. And finally, here's some feedback before we go. And first of all, just to thank all of you who joined in the other day on our Zoom call. We hope to have more very soon. So let me pick up some feedback that we've heard from some of you. Varun Gupta says he likes the topics covered and the industry experts. An anonymous listener who's an associate professor in healthcare says likes the news and the no-nonsense analysis and would like to see something like our energy focus on different sectors. Also, another anonymous listener who's a senior executive in air conditioning industry likes the coverage of micro and macroeconomics and would like to see more of global macro news. But that also reminds me that I have to get down to some more views in the air conditioning industry itself. So thank you all for your feedback and look forward to hearing more from you. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.